Hello everyone. So today's topic of discussion is liquidity. We have already discussed current assets and current liabilities in our previous videos. I'll put the link on the I button as well as in the description. Do check out those videos as well after you complete this video, because then you will get a holistic view of the overall structure of liquidity, current assets and current liabilities, and how are they connected. Right now, what is liquidity? Liquidity is basically the ease with which your assets can be converted into cash without any drop in their market value. Right now, this is easy to understand in a way that if I take an example, cash is actually the most liquid asset of all, as an individual or as a company. But if you take into consideration something like property, now property commands a market value that might be up or down from what you purchased it at, and that is why it is not as liquid as cash, and also it is more difficult to liquefy a property rather than having hard cash with you to take care of your company's obligations. Right now, there are two basic type of liquidities that are discussed. One is market liquidity, the other is accounting liquidity. Now when I talk about market liquidity basically means that to what extent the stock market, or let's say the real estate market, these are the two major markets, right? To what extent are these markets transparent and allow ease of conversion of assets to cash in a way that they are sold and purchased in the most transparent way possible? And how is a market liquidity analyzed? If your purchase price and selling price are very close to each other, that means that market is more liquid. Right, if there's a discrepancy in between the selling and the purchase price due to the demand factors, that is the time when we can say that the market is less liquid. Right now, usually stock markets are tend to be more liquid than real estate markets, obviously because of the demand factor differentiation. Now in accounting, it is completely different. Now in accounting, liquidity is basically the ease with which you can convert your assets into cash to take care of company's obligations. Now we discussed the same in current asset and current liability videos also, but again, when you see those, you will get a better understanding. It's basically converting your assets quickly, how quickly you can convert them so that you can get rid of your obligations, your rents, your let's say salaries, taxes, whatever obligations they can be short-term obligations, long-term obligations, but how quickly you can do that with your current assets, short-term assets, long-term assets, all those things. Right now, how to measure liquidity? Now there are a few formulas, few ratios which help you understand the liquidity. Now you need to understand liquidity tells the capacity of the company to liquidate its assets, and basically it also projects that it is not very like it can handle the debts, it can handle its short-term and long-term obligations, how well they can do that. Right now, first of that is basically the current ratio. Current ratio is very simple. It is usually calculated by dividing current assets by the current liabilities. Now you need to understand, since it uses current assets and current liabilities, it is usually taken care of, it takes care of the numbers that are within a period of 1 year, because current assets and current liabilities are calculated over a period of 1 year. Right, but again, a very common and a very easy ratio to understand, and obviously it should be greater than 1. So in that case, we know that company can easily handle the liabilities. Now next comes quick ratio. Now quick ratio, what companies do is it is a bit more strict formula where they calculate the cash and the cash equivalents plus short-term investments plus they calculate the account receivables, the money that is yet to come, and then they divide it by current liabilities. Now obviously they're not considering all the assets, they consider only these assets there, so this value can it will be usually less than the value of the current ratio, right? But again, it needs to be on the positive side, and if it's greater than 1, awesome, right? Now furthermore is the something called the acid ratio test. Now in acid ratio test, they subtract inventory and prepaid expenses from your current assets, and then they divide it by current liabilities. Now again, this will be less than the current ratio, because current ratio is very lenient kind of a ratio, but again it should be greater than 1. And then you have cash ratio. Now cash ratio is completely just about cash, how much cash holdings the company has versus the liabilities. So this would only include the cash plus the cash liabilities, and then divided by the current liabilities. Now you will see that there are a lot of terms that I've used here, right? Inventory, cash equivalents, and also these are already explained in my current assets and current liabilities videos. But just to give you a notice, cash equivalents are basically your very short term investments, or FDs, your term deposits that can be quickly converted into cash, and those equivalents that can be converted into cash which are within 3 months of period, right? If you have invested for more than 3 months, they won't be into security, not they won't be considered into securities and cash equivalents. But if they can be liquidated within 3 months, then they will be considered into cash. So cash equivalents are basically the second thing after cash that is the most liquid for a company, right? So I hope you understand this video. Do check out other videos also, and try to get the holistic view of it. And I hope it was very easy to understand. I'll as I've put the formulas also as I spoke. So yeah, take care of yourself. We will come up with more videos on financial ratios in detail, and yeah, I think it will be a better understanding for you. Take care. Please like and subscribe. Thank you.